Why structured investments? Well, why not? Part 2. In Part 1, we covered the background of what motivates us to invest into the financial markets. We discussed the concept of risky assets and risk-free assets, and we looked at this risk-return profile assuming a 3% inflation adjustment. We agreed that risky assets like equities carry good levels of return, but the challenge in investing into Apple, for example, is capturing and monetizing this additional return. Typically, to capture the extra return of companies like Apple, you need to be holding them for long periods of time, 10 years as an absolute minimum. In fact, Vanguard, one of the biggest asset managers in the world, talks about a 40-year time horizon when contemplating investing in companies. The reason for this long period of time can be summed up by this graph in front of you. It's a really bumpy roller coaster ride of a graph. The trend is up, but the path towards up is very volatile. The graph shows us the performance of the top performing US companies over the last 116 years. In summary, we need time and patience to benefit from equity markets. As an example, the average return that has been achieved by US companies over this long period of time was around 4.2% over and above the risk-free rate. If we look at the last 10 years, we've achieved 5% over risk-free assets. Now, 5% would suit us perfectly. 5% would cover off our inflation at 3%, and it would steadily grow our portfolio 2% per annum. The issue, though, is that this 5% didn't present itself in a predictable, dependable income stream to us. So going back to the US equity markets, it's not like we actually received 5% per annum in income over the last 10 years. At the end of the 10-year period, we can simply look at where we started off, measure it up against where we've ended up, and work out the 10-year theoretical return every year. Now, as we said in Part 1, a large proportion of wealth globally is held by those approaching retirement or those retirees. This demographic doesn't have 10 to 100 years to wait for markets to go up. They want predefined regular income now. This real need for income is why we're encouraged to buy bonds towards our retirement. Bonds provide regular and payable income. The problem is, bonds are yielding nothing right now. They don't even cover off our inflation assumption at present. Equities, on the other hand, are growing. They're growing companies and they usually yield good returns. But how do we combine these attributes? How do we combine the return of equities on the one hand with the stability and regular income of bonds on the other? Quite simply, really, good quality, wholesale structured investments. Affinity uses the safety and predictability of bonds and combines it with predefined access to equities. This then creates a predefined and payable income. Essentially, we look to capture that 5% every year, and we then look to physically pay it out to clients. We believe there are bonds, there are equities, and then there is a third way, structured investments. Structured investments combine bonds and equities to create predefined and paid out income streams. Thank you for joining us.